marketscientist.in, where India learns to trade stocks. Hello, I'm Prateek Singh from marketscientist.in, and I'd like to welcome you to the Trading Lesson Series. Today, we'll be learning a new setup, and this pattern is exclusively a buy pattern, which means that we would exclusively looking at uptrends. We would be looking at only long positions. That means we're looking for only buys, and there will be no shorts in this, meaning all you long-term investors and day traders who like going long would find this mighty useful. So as most patterns, as we do teach on marketscientist.in, work with all other time frames, which means once you get the gist of how to buy this setup, you could use this on an intraday chart, maybe a 15 or a 30 minute, and that would allow you to exit your positions before the day closes. Or you could take this a little further and open up your weekly charts and trade this intra-week or maybe 2 weeks. Take this a little further to the monthly, and you could trade this over a couple of months. So the time frame is what you decide. The frequency of the trades will decrease as you go higher up the time frame ladder. Now, let's get started on the setup itself. It's called the uptrend hammer pattern, and we have 3 basic criterias. Now, if you are just starting trading, you will need to understand that you need to have a clear entry, a clear exit, and a quantitative measured method which you could at least backtest and trade real time before you put in most of your risk. Your risk has to be calculated, and money management is of utmost importance. So the uptrend hammer pattern, basically we need our stock or our tradable instrument. Today we'll be discussing Nifty. So a Nifty is a futures instrument on the National Stock Exchange. So over here on this chart, we have Nifty, which is just broken up into an uptrend. And that is actually our first criteria. We need, in the uptrend hammer pattern, the stock to be in an uptrend. The second criteria is that we need our bar to be a hammer bar. We can see that over here we are already in an uptrend, so criteria 1 has been met. And when we go a little further, we can see that we have a hammer pattern. If you do not know what a hammer pattern is, or an uptrend is, or any of these terminologies, you could go to marketscientist.in and visit the courses tab and take the apprentice course. It's absolutely free. You just need to register. So we have criteria 2 met, that is the hammer, and criteria 3 would be that it has to have broken a previous swing low. Now, this is a swing low, and it has been broken by this hammer. When this setup happens in an uptrend, and we get a hammer back, and we get a hammer, and the hammer has broken a previous swing low, then we can buy the high of that hammer bar. These stops will be at the low of this bar. So in Nifty, when the chart that we're looking at is August 2011, Nifty was trading at 4,900 then. So we use something called a filter. You could buy a couple of points above the high of the hammer. I would use maybe 1.5 or 2 points. And after we buy, we would get that. And the next bar would be a profitable bar. We would now be in small profits. And the market continues to do its thing. And the next day, we finally get our fruit. And this move is actually a 3% return on your risk. This would be a 30-point risk, and you would have 3 times of that in this trade. Let's look at another example. This one is here. I've already marked it for you. We are again in an uptrend, some would argue, and this is our swing low, which has been violated by this bar. Now that bar, which actually violated the previous swing low, didn't do anything. But the bar after that is a hammer. So we are in an uptrend, or a trend which is about to change, but largely an uptrend. We have a hammer, and the hammer has broken a previous swing low. We can now buy the high of this hammer, and the stops would be at the low of this bar. So the next bar did not trigger anything, the bar after that didn't either, but the third bar did, so we would now buy. These are all stop orders, so this happens automatically, and your stop would be at the low of the hammer. So we're waiting, and as most successful traders or investors would tell you, that most of the money is earned after the markets have closed when you're doing your homework, and when during markets you put in one or two orders and you wait. And we did just that, and the market continues to go up, and we come out at our 3% target, or whatever your exit strategy is laid out. I have one more example for you over here. I'll just get rid of this line. Right, this would be here. Now, I don't want to confuse anyone, but you see, this is actually a downtrend. But when we have two higher swing lows, we know that we are now in uptrend territory, especially when this bar happens, and we have now broken this swing high, and this swing high. Once this is broken, we know that we are now in uptrend territory. Therefore, we know from this bar forward that the second half of 14/9/2011 is in uptrend territory. Next day, the bar opens and it's a red bar, and it goes down even lower, and we finally get a hammer bar. So we have all of the three criteria met now. We have an uptrend, a hammer, and the hammer has actually broken a previous swing low. Now you would go to proceed to buy the high of this hammer, and the market obliges and it continues up, and we come out at our 3% target. One last example to drill it home, and I won't be skipping any charts here this time. This is a clear uptrend, a hammer which is broken a previous swing low, and all the way up. This happens again and again, but I must warn you that you cannot trade with one pattern. You must trade with several. In Europe and in other countries that I've seen, stocks can move up and down independent of each other. In India, mostly when the market is going up, then almost nothing is absolute, but almost all the stocks will go up at the same time and come down at the same time, which would mean that when you get this setup, you would have the same setup in Axis Bank, the same setup in IDFC or ICICI Bank, or even Reliance Infrastructure. So what you need to do is have several setups. But if you're new to the market, then this is a great place to start, at least for the newcomer. So let's look at one last example for the investor who's looking at the daily charts. The charts that we were looking before this were Nifty futures. It was the 30-minute chart, which meant each bar was 30 minutes long. This is the daily chart of Axis Bank, and you'll notice in the bottom half we have September, October, November, which means these are months. So let's see if this strategy works here as well. I know it does because I've traded this strategy on the weekly. You get one or two trades, but it almost ensures that you're in a bull market, because you cannot get a hammer which breaks a previous swing low in an uptrend and not be in a mid or a roaring bull market. So this sort of takes care of the momentum side of things. Let's look at this in October. We were in an uptrend and Axis Bank was actually trading sideways, meaning we weren't largely moving up and down. And we have a swing low which is violated by this hammer bar. Now that is your chance to enter. We have all the three criteria met. Remember, the uptrend, the hammer, and a previous broken swing low. So this bar, which is now a hammer, the high of that would be an entry, and the low would be your stop. As we've said before, your stops and risk management is extremely important. After you've bought this, you can see that the move that is made from entry to exit, this would be about 20%, and you should have held on to this, and if you did, had the patience to, because if you're trading the daily or the weekly, you're a long-term investor. So this would be 1, 2, 3, 4, 5 months, 5 or 6 months, and from head to tip, this would be 30%. If you're trading with our strategy, you would have exited somewhere here. That would be 27% minus 2% of your expenses, brokerage taxes. You'd be left with 25% with one stock. So, well, this is what I wanted to teach you, and I hope this really did help because I enjoyed talking about it. So head on to marketscientist.in and check out our premium services. We have a live support section where we teach you live where to buy and sell, and also a small webinar, and it costs less than a losing trade. I'm sure you'll find the value for money in that and a value for your time as well. I hope to see you on the premium member section. Stay tuned for more videos from marketscientist.in. Thank you. Goodbye.